Okay, let's dive into this. Welcome back to The Explainer. Today, we're putting a truly fascinating anomaly on the microscope, Strive Inc., trading under the ticker ASST. I mean, what happens when you run a chaotic, hyper-modern asset, one that operates almost entirely on a digital age thesis, through the absolute gauntlet of classic 20th century value investing frameworks? Can the legendary criteria of Warren Buffett, Peter Lynch, and Benjamin Graham even begin to comprehend a company like this? Well, today we're going to find out as we perform a rigorous, multi-framework analysis on one of the most puzzling stocks on the market.
Because this is a rigorous, multi-framework analysis requested by you, we've got a clear roadmap to guarantee we evaluate every single angle before delivering a final verdict. We'll start with a company snapshot, then move through the Buffett and Lynch lenses, the Benjamin Graham lens, a DCF valuation, alternative valuation models, and wrap it all up with a synthesis and final recommendation. All right, Section 1, Company Snapshot and Basics. Understanding the ASST paradox. Let's get right into it.
Now, what's really interesting about this slide is the sheer contradiction staring us right in the face. Strive Inc. is a specialty asset manager, and they present one of the most dizzying paradoxes in the modern market. We're looking at a current share price of $11.11, right? But the operating fundamentals are, well, they're staggering. In Q1 2026, they posted an earnings per share of negative $4.53, an absolutely abysmal net margin of negative 9,655%, and a colossal net loss of $279 million. Yet look at that bottom row. They are holding 15,009 Bitcoin in their treasury. This is the heart of the paradox, a literal cash-burning operational furnace perfectly attached to a world-class digital asset vault. So how did they even get here? Looking at their timeline helps clear things up. Founded back in 2022, Strive originally launched to offer alternative index funds. But the real story for investors is their rapid, aggressive evolution. By 2025, they merged with asset entities and launched SATA, and by 2026, they acquired Semler Scientific. This wasn't just corporate expansion, This was a deliberate, massive pivot toward becoming a Bitcoin treasury company, bringing their total holdings to that massive 15,009 BTC mark. Moving right along to Section 2, Buffett and Lynch lenses, value versus growth perspectives. Let's personify this a bit. If Warren Buffett walked into Strive's boardroom, it would be a very short meeting. Buffett demands an understandable economic moat, which here is entirely tied to the volatile price of Bitcoin, so that's pretty unclear. He wants consistent earnings, and Strive just posted a $279 million net loss, fail. He wants a return on equity above 15%. Strive's ROE is a highly negative 139.1%. Owner earnings, also highly negative. Now, the only bright spot here is debt. With a debt-to-equity ratio of just 0.01, their debt is perfectly manageable, a perfect pass. But Buffett would take one look at those negative owner earnings, realize there is absolutely zero margin of safety at an $11.11 price tag, and just walk away. The verdict here is a solid sell. And this brilliantly illustrates exactly why we use multiple frameworks. Peter Lynch, on the other hand, might actually pull up a chair here. Lynch categorizes companies, and Strive sits super awkwardly between two of his buckets. On one hand, their Q1 revenue grew 94% year over year to $2.76 million, hinting at a fast grower. But more accurately, Lynch would classify this as a classic asset play. An asset play is just a company sitting on something incredibly valuable that Wall Street has completely overlooked. In this case, a massive hoard of Bitcoin. Lynch also looks at a few other key metrics. Now, we have to completely throw out his famous PEG ratio because it's mathematically invalid with negative earnings. But this number right here, 5.52%, is absolutely crucial. That is Strive's extremely low institutional ownership. Lynch loves this. He views low institutional interest as a huge positive, basically meaning the smart money hasn't crowded the trade yet. So combined with their pristine balance sheet, Lynch would actually likely view ASST as a speculative buy. Let's shift gears to Section 3, the Benjamin Graham lens, the father of value investing. So, would the strictest value investor in history find a margin of safety here? Running Graham's defensive checklist, we get a really fascinating split. Strive passes the adequate size test with an $818 million market cap. They also easily pass the strong financial condition test with a phenomenal current liquidity ratio of 11.44. But then, the whole framework begins to crack. Earnings stability? Total failure. There's no dividend record, and they failed a moderate price-to-earnings test with a negative 1.30 PE.
And actually, it gets worse for Graham when we try to calculate his famous intrinsic value formula. The formula is the square root of 22.5 times EPS times book value per share. But because Strive's EPS is a highly negative 4.53, the math literally breaks. You can't take the square root of a negative number in this context. It just outputs an error. At $11.11, the margin of safety doesn't just fail, it doesn't exist. Graham wouldn't touch the stock with a 10-foot pole at any price. Verdict: strong sell. All right, Section 4, DCF valuation and projections, finding the cash flow. Let's try modern, forward-looking valuation models. To build a base case discounted cash flow model for a company burning this much cash, we have to make some incredibly explicit, generous assumptions just to see if we can justify the price tag. Step 1, we start with their highly negative current free cash flow. Step 2, we must theoretically assume a miraculous path to profitability over the next 5 years. Step 3, we apply a very aggressive 15% weighted average cost of capital, or WACC, because holding that much crypto introduces massive risk and volatility. And finally, step 4, we assume a standard 2% perpetual terminal growth rate.
So the crucial point is this. Looking at the sensitivity table, even if we toggle the WACC between 10 and 20% and the terminal growth between 1 and 3%, the discounted future cash flows never climb out of the negative hole created by that current $279 million net loss. Across literally all sensitivities, the fair value of Strive's operating business per share is effectively zero, or negative, without its balance sheet assets. If you're buying this strictly for its future cash flows, the DCF model says, sell.
Which brings us to Section 5, alternative valuation models, sum of the parts, and reverse DCF. Now, since traditional cash flow metrics have completely failed to explain the $818 million market cap, this is where the story flips entirely. Using a sum of the parts model, we look at the components of the business separately. We've already established the operating business has minimal, if any, positive value. But with Bitcoin recently topping $75,000, Strive's 15,009 BTC vault is worth over $1.12 billion. Let that sink in. The entire company is trading at an $818 million market cap, meaning the stock is actually trading at a massive discount to its pure Bitcoin holdings.
And a reverse DCF confirms exactly what's happening here. A reverse DCF asks, what operational growth is required to justify the current price? The answer here is an impossible level of operational revenue growth. This confirms the market assigns absolutely zero value to the core business. Investors are simply buying the stock as a discounted proxy for Bitcoin itself. Under these alternative models, the stock is deeply undervalued. Verdict: buy. Finally, Section 6, synthesis and final recommendation. Clash of eras concluded. Let's move to and see how this all builds together into our final investment matrix. Traditional cash flow-based value investors like Buffett, Graham, and standard DCF models demand a $0 entry point. To them, it's an undeniable sell. However, Peter Lynch's framework and the sum of the parts model view this entirely as an asset play. Because the underlying Bitcoin treasury suggests a fair value well north of $15 a share, these models scream buy. Blending these insights, ASS is not an investment in an operating business at all. It's a highly speculative buy solely for crypto bulls looking to acquire Bitcoin assets at a discount to net asset value. For anyone else, it's a hard pass. Which leaves us with this final provocative thought. Does a massive Bitcoin treasury justify a bleeding core business? We are literally watching the rules of investing stretch in real time. Can a company indefinitely sustain a cash furnace just because it sits on a mountain of digital gold? I'll let you ponder that. Thank you so much for joining me on this deep dive. I hope this structured look at Strive Inc. gave you the clarity you need to evaluate modern asset plays through time-tested lenses. Until next time, keep analyzing and keep learning.